Why real estate prices fluctuate so drastically? What makes a downtown property skyrocket in value while suburban homes lag behind? Or how inflation and interest rates influence the cost of your dream house? Today we're diving deep into the impact of macroeconomic factors on real estate prices, from interest rates to inflation, and even the role of bureaucracy. You will discover how the bigger economic picture shapes the homes we buy and sell. Here, high-end design meets reality. The relationship between macroeconomics and real estate isn't new. Take the 2008 financial crisis. Inflated housing prices, fueled by loose lending, triggered a global recession. Or look at the housing booms of the 19th and 2000s in Europe and the US, where deregulation and speculative buying reshaped urban and coastal landscapes. These historical shifts remind us that real estate is more than just brick and mortar. It's a reflection of economic tide, cultural preferences, and government policy.
Interest rates and inflation.
Interest rates set by central banks are a linchpin in real estate. Lower rates make mortgages more affordable, spurring demand and raising prices. But when rates rise, borrowing costs climb, cooling the market and slowing development projects. If you didn't catch this last part, don't worry, it is normal, because I just have thrown you a lot of economic relation in seconds. So rewind and play that little part, even at slow pace, anytime you need, because that sentences explains almost everything in macroeconomics. For instance, after inflation surged to 5% in the US in 2021, construction costs jumped 30%. Developers passed these costs onto buyers, driving up property prices. This creates a double-edged sword. Buyers face reduced purchasing power, while sellers contend with higher expenses. The key takeaway: monitor interest rates. They're not just numbers, they're the pulse of the property market.
The Blob Team. Bureaucracy in action.
Bureaucratic delays are a silent killer in real estate development. Stricter zoning laws and lengthy approval processes increase project costs and timelines, fueling housing shortages. Take San Francisco. A housing project there can take up to 4 years for approval, hindering supply while demand climbs. The result? Sky-high rents and home prices. Streamlining these processes would help developers bring high-quality projects to market faster, benefiting everyone.
Navigating trends for successful development.
Real estate thrives on timing, location, and adaptability. Developers who balance these factors succeed in markets where macroeconomic conditions can change overnight. Here's some tips for developers. Secure land early. Buy in emerging areas before demand peaks. Think sustainable. Projects that incorporate energy efficiency and luxury features appeal to eco-conscious buyers. And mitigate risks. Plan for inflation, interest rate hikes, and delays during the construction phase. If you like this topic, here you can see the first part of this video where we talk about the differences between urban, rural, and coastal real estate markets. Let's mark down some of the most important tips we have mentioned. 1. Start with location and timing. Secure land in an up-and-coming areas before the market peaks. Long-term financial planning is essential to weather the fluctuations in market demand and construction costs. Create value through smart design. Projects that prioritize energy efficiency, luxury features, and long-term sustainability attract eco-conscious buyers and investors. 3. Understand bureaucratic processes. Expect delays from permits and legal processes, but use this time wisely to refine your project for better returns in the long term. Stay on top of construction risks. Regular quality inspections and effective management of potential delays or cost overruns during construction are crucial. Leverage macroeconomic factors. Monitor interest rates, inflation, and government policies, as these will heavily influence property prices and buyer behavior. Choose between city, coastal, or rural, or newly built or existing home market. Each property market offers its own set of benefits and risks. Developers and buyers must assess their goals and choose accordingly. Keep the bigger picture in mind. Markets are cyclical, and by staying informed and prepared, developers can weather downtowns and capitalize on upswings.
Remember to look at the big picture.
Macroeconomic forces like interest rates, inflation, and government intervention are powerful players in shaping real estate prices. To succeed, developers and investors must remain adaptable, informed, and strategic. By keeping these strategies in mind, you can buy the house of your dreams, make informed decisions on investing, develop properties that meet the market's evolving demands, and position yourself for success in a rapidly changing world. Share your thoughts in the comments below and also some of your suggestions for the topics to address in future videos. Thanks for watching, see the big picture and keep thinking forward.